Now, let's try to understand the different types of debt instruments which can be issued by the company, which can very well be categorized as a part of the loan capital. So, as a part of this, we'll try to know about the very basic loan capitals like bonds. Then we'll talk about the debentures. How do we differentiate between the two? Then what do we mean by unsecured loans? Then what is the subordinated debt? These are all different forms of loan capital. Even in the international market, we talk about the Eurobonds. And finally, we will also try to understand what are the floating rate notes. Now, basically, when I'm trying to understand all these, I should be able to differentiate between each of the types of the debt capital. So, just why do we really, why does an organization require a loan capital? Now, this is primarily to expand. This is one major mechanism of raising money from outsiders. Obviously, we know the two major forms of raising capital, debt and equity. So, the debt is majorly the part of the loan capital and equity comes under the share capital. So, in many of these debt instruments, it is like a loan that is taken or a bond that is issued, very traditional one. So, by issuing a bond, the company is raising some capital, and on that loan that it has taken, it will pay a stream of interest payments. In case of bonds, that interest payment is called as a coupon, and along with that, the capital would be returned. So traditionally, there are two mechanisms in which this can happen. Probably, let's say if we are talking about a 5-year bond. So for 5 years, the company has taken something on loan. Now, in this, there are two ways. Every year up to 5 years, the company can just pay an interest that is mentioned at the outset, and in the final year, it can do a return of the capital. So this is one way. And the other way is what we call as the amortized form, traditionally works for a loan. So across these 5-year period, along with the interest, some portion of the principal also will get returned back, which is resulting in such a way that at the end of 5 years, the principal is also completely exhausted of. Whatever is the mechanism, whether it is this kind of a mechanism, there is a stream of interest payment plus a return of the capital, or an amortization kind of a payment, both of them are specified at the outset. And the good thing is there is a secondary market for this loan capital. So all these bonds, there are majority of the bonds that are listed on the stock exchange. And whosoever has purchased these bonds, they are like they have lent to the company. They have lent some money to the company, so they are the creditors, but still they don't have any kind of voting rights. They are not the owners. They are the lenders to the company. They are the creditors, right? And a few important things. Whenever I am looking at a conventional loan, right? Here we always look at an interest payment which is generally established as a proportion of the par value of the company. Par value is nothing but the face value, which is not necessarily the same as the market value. The market price could be more than this or could be lesser than this. So if the market price is more than the face value, we say that that bond is being sold at a premium. And if the market value is less than the face value, we say that that bond is getting sold at a discount to the face value. So that's important. Otherwise, we say that it is getting sold at the par value itself. And whatever is the interest, generally we use the word coupon for the interest. It is established as some percentage of the par value. When I say 7% and the par value is 100, which means every year $7 is being paid in the form of coupon, and the par value is paid normally on the maturity, right? And generally the issue price, which is the market price which is paid for it, generally it could be paid price close to the par, or in some cases above the par which is at a premium, or below the par which is at a discount. And in majority of the cases, the redemption which is on the maturity, the replacement, the payback that happens is the par value itself. These are some of the very common features associated with the loan capital. And what does the lenders get here, who are called as the bond holders? Whatever are the rights that are associated with them, what all they can do if the company did not pay back or failed to pay the interest and principal as they fall due. That is actually termed as default. What are their rights, what they can do, what they cannot do, that entire thing is specified in the loan agreement. This loan agreement is, in other words, called as the bond indenture. So the do's and don'ts are mentioned clearly. And to protect the interest of all these investors, there is a trustee that is appointed. Generally, the trustee is either a bank or an insurance company. And there is a trust deed which clearly specifies what is that the company has to do, what is the obligation of the company towards its investors. So all that goes as a part of the traditional loan capital. And slightly a different form in that loan capital is the debentures. It is secure. Secured means it's a kind of collateral, right, on some or all assets of the company, which means this is like a secured. Okay, in case the company defaults in terms of paying the interest or the principal payment, now some or all of the assets of the company can very well be sold, and the proceeds can be used towards the payment of the loan. So this is what will give an advantage in case of a debenture, because anytime there is a default, what are the things that can happen? I can, let's say I have given a loan to the company and the company has defaulted. I can go for appointing a receiver. So it's like a collection agent who will try to generate the income from the secured asset. So this can be sold and generation of the income can happen. And or I can take the possession of that asset. If let's say a vehicle has been kept as a collateral for the sale, I can take the possession of that vehicle and I can sell it, and whatever are the proceeds that come up, I can use those proceeds for the payment of my debt. Right? So that is what is the advantage that comes in a debenture. And in a typical debenture, we see there are two types. One is called as a mortgage type debenture where the charge is fixed. So in that case, I clearly talk about specific secured asset. So I'll clearly specify what is it that is kept as a collateral here. Okay, am I keeping my property as a collateral? If so, which property? How much size? What is the size of that property? The whole details of the property, which is more and more specific. Or am I keeping my vehicle as a collateral? If it is the case, which vehicle? Now that is what comes as a part of the mortgage or a fixed charge debentures. And in the other case, we talk about the floating charge. It is like if at all I want, I can change the secured asset. Right, from X, initially I have kept a property 1 as the collateral. Now I want to change it to property 2. That can very well happen. Equally satisfactory asset needs to be replaced. And in case the default happens, whosoever has invested in that debenture, called as a debenture holder, they can go to the court And in that case, the floating charge can very well become a fixed charge, which means whatever is the asset, that asset gets frozen. And generally, the debentures are used by the companies to raise large volumes of funds, and they have a fixed redemption date. What is the maturity date? The other ways we can call this as a maturity date. And the interest rate also is more or less fixed. It's not a floating rate of interest. And the interest payments are tax deductible. What do we mean by tax deductible here? Okay, whatever the revenues the company has generated, the expenses the company has. So once I take out revenues minus expenses, we typically call it as earnings before interest and tax. Out of that, I take out interest, earnings before tax, and on the top of it, the tax is applied, which means on the interest that is getting paid, I'm getting a tax benefit, because tax is not getting applied on EBIT, tax is getting applied only on EBT. So that's how the EBT, after the EBT only the tax is applied, which means that is what I am calling as interest is tax deductible. But interest is made, interest must be paid irrespective of the company's profitability. That is what is the risk portion that is associated. If I am talking about equity capital, I will actually make the payment to my shareholders in the form of dividend only if the company makes a profit, but that is not the case with respect to the debenture stock. Even if the company does not make a profit, even if it is into a loss, the interest payment has to happen, right? So that is one major risk. And the biggest risk is at any point in time the company may default, which means when we are using the word default, the coupon payment or the capital repayment may not happen on time. And if it is a secured asset, fair enough. The secured asset can very well be sold off and the proceeds can very well be used. And the other major risk that comes up is whatever are the values, they are very much exposed to market risk, because I know how much amount has to be paid in future. Okay, how much amount I am going to receive as an interest in future. But at that point, if the market interest rates are much higher, let's say I would be getting at the rate of 7% after 1 year. But after 1 year, the interest rates, let's say, are 9%. So what I am getting actually is much lesser than the prevailing interest rate. So in that case, the value is more or less eroded because of the inflation. So that is one more risk that can come into picture. And to a large extent, when I compare the debentures with the shares, the marketability is also much lesser. I can't sell them whenever I want, and it's not that easy to transfer the debentures from one party to the other. So there are a lot of benefits, and at the same time there are a few limitations as well. Then on the other side, we will look at the unsecured loan stocks. Again, when we use the word loan stocks, it's nothing but the bonds. Unsecured bonds. Unsecured bonds, which means no security. So they are always ranked below the secured bonds. So we can call them as ranked below the debentures. So the what can typically happen is, in case the company has defaulted, they can only sue the company. And after the payment happens to all the senior debt holders, like debenture holders and all, after them only the payment for these unsecured loan stock holders is going to come up, which means along with other creditors of the company. Who are the other creditors? Typically the trade creditors who have supplied the raw material, and those kind of people will come at par with this unsecured loans. So which means basically all the senior and secured people would be first settled, and after that whatever are the proceeds that come post the selling of the asset, that amount will be shared with the unsecured loan stock investors. So because of that, there is an additional risk with the unsecured loan stock. And because of that, the returns, the expected returns which are measured in the form of gross redemption yields, they should be higher compared to the debentures. Because there is a greater risk, because they will be paid after the debenture holders are paid in case the company has defaulted, and their marketability is also much poorer compared to that of the debentures. Then even more subordinated means even below the unsecured, right? This is even more riskier kind of a debt. So probably if you look at the order, one, there is a secured, and then we are talking of unsecured, and probably even much below it we use a word called subordinated, or sometimes we call it as junior. And to a large extent, people try to consider this more or less equal to the equity or slightly above the equity investment. It's as good as an equity. So the ranking is much below, even below the general creditors, because general creditors are ranked more or less at par with the unsecured debt. So there is, it's called as a junior debt. After all the debt holders' requirements are satisfied, if at all there is anything left, then it is paid to the subordinated, which means the risk for these guys is much higher. So they will expect the expected return for these kind of investments is much higher. Sometimes we even call them as high yield bonds, or we typically also put them as non-investment grade bonds, or sometimes there is even a common name called junk bonds. So all these things are the typical names for this subordinated debt. So the rating of the debt, which will have a very poorer, they don't get the investment grade rating, they get a double B and below kind of credit ratings. So this will clearly reflect the security that is associated with these instruments. Then the other important tool that is available, the other important bond or the loan kind of a capital that is available is targeting the international market. Because till now, whatever are the different kinds of loans which we talked about, whether they are secured or unsecured or subordinated or whatever we have talked about, we have been looking at from a particular country's perspective. So whatever is the loan or a bond the company has issued, the tax and the legal perspective, both of them are belonging to a particular country. Now, we are talking about Eurobond. There is a possibility to borrow in the other country. That is what we call as the Euro market, right? So we are going for a loan capital. I'm not bothered about the legal or the tax considerations of any particular country. And at the same time, I'm raising the capital, I'm borrowing without actually entering into the financial markets of that particular country. And now that no government intervention is there, there is a possibility that I can get a much lower interest rate because of the competitive position that is there. I can get a much lower interest rate because of the international advantage. But at the same time, if I have to convert it back to my domestic currency, then probably the exchange rate risk could very much be possible. So I have to really balance between the two. And the bond issue can be done even if I am an Indian. I don't need to raise the capital in rupees. I may think of raising the capital in dollars. So whatever is the currency I want, I can very well raise. And it's just not, the euro is just a misleading word. It's not just in euro as a currency. Currency could be anything. So I am raising the capital in the international market. I am borrowing in the international market and in the form of a loan without getting guided, without getting led by the legal or the tax considerations of any particular country. So the companies throughout the world can raise the money. It is redeemed at par. There is a fixed date. The coupon is fixed. It is generally unsecured. And an important part is it is a bearer form document, which means there is no name that is printed on it. Just like our currency, right? If you look at our currency, whosoever holds that paper of currency, $100 note, he is the owner of that. There is no name of the person on that currency. The same thing happens with a Eurobond. So whosoever really wants to get the interest payment, the coupon is cut from that certificate and it is sent to the company. It's not that because there is no name or account holder specifically written for those kind of securities. Whosoever has the document, he is the owner. That's it. Probably the best thing is like a currency, which is more like a promissory note or probably a bearer form of a document. Whosoever holds it, he can present it and he can get the benefit out of it. So that's the reason, if at all some kind of interest or principal redemptions have to happen, it's just that I cut the coupon from the certificate and send it to the company. Many a times they are fixed coupons, but we see that there is a possibility of a variable coupon also, which is called as a floating rate note. And these are generally used for raising large capitals to the extent of minimum of $75 million. And the whatever the gross redemption yield, which is the return, expected return that you can get, it is purely based on the credit quality of the issuer, the size, which is more to do with the liquidity, marketability of that in the international market, and the inflation. All these things will really influence the gross redemption yield. In some cases, it could be much lesser than you raise the loan in your domestic market because of the less influence of a particular country's tax and legal framework or regulatory aspects on the issue. And finally, looking at the floating rate notes, which are, the word itself is saying here the coupon is not fixed, it's floating. And to a large extent, we see they are medium term securities, which are generally between 5 to 10 years maturity. And they are issued in the euro market, means the capital is raised for a medium term in the international market where the interest rates are more or less floating. So the interest rate payment change with the short term interest rate. Probably the base could be a 6-month LIBOR. So depending on how the 6-month LIBOR is changing, the payment, both the coupon as well as the principal payments will differ. And in some cases, there could be some kind of a minimum fix. Probably if the interest rate falls below 5%, you still have to pay 5% coupon. Some such kind of restrictions could be there, but anything above 5%, probably it should be the floating. So these kind of restrictions could be there in some cases. So which means here, from the issuer's perspective, he really need not do a very thorough study in terms of how the interest rates are going to be there in future, how the inflation is going to change in future, is it going to increase or decrease? No such need, because if it is increasing, obviously what he has to pay will increase. If it is falling, what he has to pay is falling. And even from the lender's perspective, he is not bearing the inflation risk. He is not bearing the future interest rate risk. Now, because of that, he need not require any kind of a premium for getting compensated towards that. So these are the different kinds of loan capitals that are available for the companies to raise the capital, and probably different tools like this have different advantages, and in different contexts we see companies raising them to suit to their requirement, right?